Hello, Nebraska, and welcome to this week's edition of the Retirement Compass, the show dedicated to helping you successfully navigate to and through your retirement. I'm your host, Kristen Oakley, and joining me in the studio, we have Tim Kulhanek. He is the co-founder and a financial advisor from Stonebridge Wealth Systems, along with Jeremy Gove, who is a partner and financial advisor there as well. We have a great show prepared for you at home today. We're going to be diving in all into the important subject of taxes, which is something that affects every single person watching this show, but in particular, if you are a small business owner or if you are paying taxes as an individual, you are not going to want to miss today's show. Tim, Jeremy, such a joy to be back in the studio with you.
Good to be back with you.
Yes, thank you. And I know that planning, we talk about this on the show all the time, but today we're going to specifically talk about tax planning. So let's set up the conversation today. What makes tax planning so different and unique and sets you and the team of Stonebridge Wealth Solutions apart in this space?
Sure. So I think really where I would start the conversation is focusing on the type of solutions that our audience is being offered or that they have access to in their current financial planning arrangement. So when you think of like a triangle, at the base of that triangle, we've talked about this on past shows, you've got like product providers. Above that, you've got asset managers. But the often overlooked aspect is what we call holistic planning, where you're looking at all the 5 points of the compass: income, investment, tax, healthcare, and legacy. And what we found is tax planning, some strategic tax planning, can make a huge difference in somebody's financial life. Get this. So a study that comes out every year, it's by Russell Investments. There's other companies like Morningstar that would back this up.
Independent third parties.
Independent third parties that are designed to find out what is the value of a financial advisor? What kind of value can they bring to the table? Is it because they pick better stocks? Turns out that's not the case. In fact, if you look historically, the vast majority, this would be according to Forbes, another third party, the vast majority of financial investment managers on Wall Street don't outperform just an unmanaged benchmark over time. So it's not picking stocks. Where we can add value, a lot of value to our clients' lives, is in the planning phase, in tax planning. In fact, according to Russell, 1.17% per year can be added to your return if you have a strategic tax plan. So that's looking at things like, what's my income tax bracket? Should I be putting money into a pre-tax account like a traditional IRA or a traditional 401k? Or should I be looking more down the road and doing, again, tax planning versus preparing and looking at, maybe I need to do more into the tax exempt bucket, or the tax never bucket would be the Roth bucket. For our business owners you mentioned, looking at your business structure. Should I be filing as a sole proprietor and filing that Schedule C? Or should I be expanding that and looking at maybe setting up some sort of business entity, and maybe I file, maybe an LLC, or maybe I file as an S Corp. That's something that I did years ago, and it saved me a boatload in taxes. So often overlooked, but can make a huge difference long term for your financial success.
Well, because at the end of the day, it's not about how much you have, but it's about how much you get to keep. And I think that's the difference, right? That's what tax planning is doing, is looking ahead and really figuring out how much you can save over the long haul.
Absolutely.
Yeah, for sure. Well, one of the things I had to look at my notes here to not get this wrong, because we all know that the tax code is very, very complicated, but there are approximately 6,800 pages in the tax code. And then with the official guidance from the IRS, if you put that all together, that expands to over 75,000 pages. So my gosh, how is anyone supposed to make sense of all that and keep up, especially when the laws are always changing?
Yeah, absolutely, Kristen. Well, and as we were preparing for the show, I was, the term complicated comes up when we're talking about taxes. And I was trying to come up with a better word because I'm not sure complicated actually does it justice, because like you said, there's 75,000 pages. And if you look at, even there's different studies that I've read where the IRS has a hard time processing all of it. There's just so much to it.
Yes, so much to know and then so much to keep on top of.
Exactly.
Yeah.
And so when you think about income just in general, when you're working, when you have a W-2 or maybe you own a small business, your income is taxed basically one of two ways. You have payroll taxes, and then you have income taxes, which would be state and federal, right? And so as you're working and in your earning years, that's where you're paying your taxes. But once you retire, it becomes a lot more complicated because depending on where your income is coming from, that's going to have a major impact on how much taxes you pay. For example, if you get paid Social Security and that's the only income that you get, there is no tax on that. But if you add in additional withdrawals from, let's say, an IRA or other pension income or other things, now part of our Social Security can become taxable. And so it's just a very complicated process. And so, you know, you have basically two options: work with a financial advisor or have a really good CPA and a financial advisor, or you can go out and learn the tax code yourself. And you know, there's a lot of times where we read tax returns for people and we see there's a lot of deductions that they're missing, or if they would have taken income in a different way, they could still have the same standard of living, but maybe their income would have been different, or it would be taxed differently.
Yes, right. And there's different tax treatment to all these things. And to your point too, a lot of people are shocked when they find out that potentially up to 85% of your Social Security benefit could be taxed. And if you make a decision in one area and you get it wrong, then you can also be hit with massive penalties, and we don't want you to be subject to those either. So what are some practical tips to really help folks engage in this strategic tax planning?
I mean, some light reading on the weekend, 75,000 pages. Just
if you're having trouble falling asleep or struggling with insomnia, right?
Warren Buffett, what did he read? Like, he reads like 500 pages a day. He spends like 80% of his day reading. Maybe that's an urban legend. I don't know. But really, again, it comes back to having a strategic plan in place. So what Jeremy was talking about a second ago, where he's talking about these different types of income, that like Social Security is not ordinary income in and of itself, but then you start adding these other things. So, okay, I reach age 73, depending on when you're born, what we call a required beginning date, 73 up to 75, and I've got required minimum distributions out of my pre-tax accounts. Okay, well that's one complicating factor. You throw in, maybe I get some interest. Now the interest rates are much higher. Oh, well, guess what? What form does the government, or not the government, the bank send to you at the end of the year?
1099 interest forms.
They're ratting you out, right?
Yeah.
Saying, hey, we sent you some interest, so we're going to send this to the IRS, so you have to pay taxes on that.
Right.
And so what we find is we've got to have some sort of strategic plan in place. And most people don't realize the impact of taxes. Think about this. So I asked this at workshops. Let's say that you need $100,000 after tax, and you're at the 30% combined rate, federal plus state, and you have an IRA. How much money do you need to take out of your IRA to net that $100,000?
So I bet most people do 30% of 100 grand, and they say that would be 130,000.
99.9%, so 130,000. The problem is, it's actually much higher than that. It's about 142,857, because that 30% has to come out of that higher number for you to net that 100,000.
That percentage math, it gets us all every
It gets
single
us all
time,
the time.
right?
So the moral of the story is this: if you don't have a strategic tax plan, if you haven't created what we call a tax map, so you understand how all these different types of income work together, how you can avoid paying taxes on things like Social Security, how you can stay in the 12% income tax bracket so that way your long-term capital gains are taxed at zero. If you don't have a strategy to obtain that, that would be a reason why folks out there would want to give us a call today and go over a retirement readiness review and put together their individual customized tax map so they can make sure they're keeping more of that money in their pocket and not giving it to the IRS.
Absolutely. Well, Tim and Jeremy, I know we have so much more to get into on today's show, but what an awesome start to just help kind of peel back the layers on how complex and complicated this is. But while this might be new to you, the good news is it's not new to Tim and Jeremy and the team of Stonebridge Wealth Systems, and they would love to help and serve you. To be able to get your own complimentary written financial plan, and as part of that, this complimentary tax map, we encourage you, pick up the phone, call that number on the bottom of your screen, 866-256-7778. You're also welcome to take out your smartphone, and you can simply scan that QR code down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team from Stonebridge Wealth Systems will reach out and connect with you to schedule your complimentary visit that way as well. More on today's important discussion on taxes right after this.
I own a motel I was able to buy out of college. When I actually ended up buying the motel, I was leaving. I had just passed the life and health license, and I was going to sell Medicare supplements and long-term care. I told the owner of the motel that, hey, I'm going to be leaving. I was giving him a 6 months heads up that, hey, I'll train whoever you want to bring in. He said, I'd actually rather sell you the motel than bring in a new manager, because he never showed up. So he didn't have to do anything. It was kind of like an ATM for him. And so, you know, when you own your own business, there's a lot of people that got to be paid. There's marketing that has to be done. There's a lot of different dynamics that go into running a motel. It actually taught me to think outside the box a little bit. And so I started looking around, what are other things I can do? Because I really liked helping people. I liked solving problems for them. And there's a big difference between selling something and actually finding solutions to problems. When you're thinking about personal finance and managing somebody's retirement for them, they've worked for 40 years saving all this money and now they're retiring. They're turning this over to you to take and run with it. So it's a big deal. I think we can always do stuff better. There's always room for improvement. And so I want to read as much as I can. I want to study as much as I can so that I can do a better job for my clients, which they're counting on me to get the job done for them.
Welcome back to the Retirement Compass, brought to you by the team of Stonebridge Wealth Systems. I'm your host, Kristen Oakley, and I'm here with Tim Kulhanek and Jeremy Gove. And we should point out, gentlemen, that an important change has happened since our last show together. The name of your company has actually changed to Stonebridge Wealth Systems. So talk about that for a minute.
Sure, yeah, I can hop in.
Yeah.
I think it really had to do with the fact that, while we still are a full-service financial firm, so we still have access to help clients with their healthcare needs, whether it be long-term care. We've got strategic partners to help people with Medicare because that's such a confusing time.
Yep.
Really, we want to focus on the fact that we have a system in place that's designed to take people from their accumulation phase to the distribution phase. A system, something that's repeatable,
Yes.
right? It's observable, measurable, and repeatable.
Right.
And we can duplicate that at all our different locations. So here we are.
I like that. Well, everyone wants to be plugged into a system that works. Again, we're talking today about taxes, and it's not about how much you have, it's about how much you get to keep. And that's something that Tim and Jeremy and the team of Stonebridge Wealth Systems are really passionate about helping folks do. Of course, it's just one piece of an overall retirement puzzle, if you will, but it certainly is a critical piece. So in this conversation about taxes, I know that one of the strategies that you're able to help folks employ for themselves is using charitable donations. So let's talk a little bit about that. How does that fit into someone's overall strategic tax plan, if you will?
Yeah, it's a great question. So most of our clients, or a lot of our clients, give money to a church, for example. And so one of the things that a lot of people don't know about is when you turn 70 and a half, you can do what's called a qualified charitable distribution.
Otherwise known as a QCD. We
QCD.
love our acronyms
We love
in this
the
industry,
acronyms,
right?
Yeah, it gets very confusing. So a QCD is simply when you turn 70 and a half, if you're giving money to your church or to a charity, when you turn 73, this has been changing as well. It used to be when you turn 70 and a half, you had to take RMDs, required minimum distributions. But now that's been bumped back to 73 and potentially as far as 75, depending on how old you are now. But the point of the qualified charitable distribution is you can actually give that money to your church or to your charity of choice, and it actually goes to them, but it doesn't count as income for you. What happens a lot of times is people will take money out of their IRA, they'll pay tax on it, then they'll give it to their church. And with the tax laws that changed in 2017, most people are not itemizing on their taxes anymore. So it's more challenging to claim that gift or that you're, as a deduction. And so by doing a QCD, you can actually give, let's say, a couple $1,000s to your church directly. It doesn't count as income for you. And then, you're still meeting the obligation that you want to meet in giving to charity, but it doesn't increase your tax. And so it's a great way to do that. I mean, if you look at today, I don't know the exact number, but it's approximately 80% don't itemize anymore. And so that can be one way to still capture that in a roundabout way.
Right.
So that's one of the things we talk a lot about. But just in giving to charity in general, one of the things that people aren't familiar with are donor advised funds. For example, if I'm a small business owner and I'm selling my business, what am I going to do? I'm going to pay a lot of taxes, most likely.
Right.
And if I'm a charitable person and I want to give money to a charity, but I don't want to give, let's say I want to give a couple $100,000, but I don't want to do it all right now. I can give that money, get the credit for giving it this year, and put it in a donor advised fund, and then down the road, I can choose where that money actually goes to. So not only is it the money that I put in there, but it also grows tax-free, kind of like an IRA, grows tax-free, and when it goes to the charity, it's going to them tax-free.
Wow. And that just makes it a win-win for both parties involved,
absolutely,
right?
Absolutely.
When it lowers your tax liability as the person who's making the contribution, and I know several people that this is what they do with their RMDs, right? Their required minimum distributions.
Yes.
Let's say that you're in a fortunate enough position where you don't need that money to live off of, but you don't want to incur the tax liability that inevitably comes. Well, boom, this solves that issue.
Yeah, absolutely.
Yeah, and I was actually going to mention that it counts against your RMD. So I'll give you a quick example. I had a client who came in and his RMD, his required minimum distribution for this past year was about $30,000. Well, he had a list of, believe it or not, 14 different charitable organizations that he wanted to support, which is amazing. So, and it doesn't matter as long as they're a 501c3. So, like some of his were like Tunnel to Towers or the American Heart Association or Compassion International and sponsoring some children. That's something that my wife and I are passionate about supporting is children that are less fortunate living overseas. Whatever organization it is, he made a list for me, basically a spreadsheet, and said, hey, here's how much I want to give to each one of these charities. Here's the tax ID. Here's when I want it to go out. As long as it goes out by December 31st of that calendar year, then it'll count as a QCD. It'll count against your RMD. So if you were supposed to take $30,000 and he gave $10,000 to charitable organizations and maybe $10,000 to church, all right, well, I only have to experience $10,000 that's actually going to hit my tax return to my RMD.
Right.
So that's a great solution. The other great solution Jeremy mentioned is the donor advised fund. Again, I like stories. So how can I make this practical for our viewers? And so I had a client last year who sold his business. This actually happened. And he sold the building and it was basically depreciated out. And so he had a big capital gain. And he sold it, I think the gain was like $300,000 or $400,000. And so he ended up putting $100,000. We set up a giving account, and let's say it was Bob Smith, generic name, right? Well, the Smith Family Fund is what we name that. We put the $100,000 in, and if you give cash, you can deduct up to 60% of your adjusted gross income. Well, his adjusted gross income was much higher than that, so we gave the $100,000. He was able to deduct all of that, and then he can make grants on an annual basis.
Wow, that's amazing. I
Yeah,
mean, there's
works great.
again, those 75,000 pages we talked about, there's so much in the IRS code that you can actually use to your advantage. And I think a lot of people forget that. I think people just kind of take it on the chin and assume, well, I got to pay tax, right? But the tax code was actually written to help folks pay the least amount of legally required taxes possible. And I don't think a lot of people realize that. So I love that you're able to kind of show all these different scenarios for how people can keep more of their hard-earned money, allow more money to pass to charity, and lower their tax liability at the same time.
Yeah, one of the things that we find a lot is when you work with a CPA, when I talk about taxes with clients, they always say, well, I already have a CPA that handles that. The challenge with the CPA, and there's a lot of really good CPAs, but they're always looking backwards.
Yes.
And they're always looking at how can I save on your taxes today? By working with a financial planner like our team, we're going to look at how do you save taxes today, but also how do I save taxes 5 years down the road, 10 years down the road? And that's really important also to consider.
For sure, because how you make a decision in one area of your financial life can and will affect all the others. We say this on this show all the time. Well, I want to touch briefly before we take another break. A lot of people are familiar with wanting to grab tax deductions today. Most Americans have the bulk of their wealth saved up in something like a 401k, a workplace retirement plan, these tax-deferred accounts. Maybe you have a 403b or a 457. What other types of retirement accounts are available for folks to really take advantage of if they need the tax break today?
Yeah, it really depends on what your situation is because there's a plan for everybody. Let's put it that way. And one of the things that we specialize in here at Stonebridge is finding solutions, whether you are working out at Kawasaki or Eaton, and you've got maybe a pension plan that you're going to have access to, and do I do a rollover? Do I have company stock in my 401k? But also the business owner. We work with an awful lot of farmers. Those are small businesses, and there's good years and bad years. It's a volatile, high risk, high reward at times type of hard-working industry. But there's times where things worked out. Last year is a better year, so 2022, where grain prices were much higher, and there's a big tax burden. We've been able to set up a type of plan called a cash balance defined benefit plan, where we can create
cash balance defined benefit plan.
Yes.
That's a mouthful.
So
Okay.
it is, and it's kind of a hybrid type plan. It has characteristics of the old school pension defined benefit plans,
Okay.
but also characteristics of more of a defined contribution, like 401k. And so you're defining rather than an annual payment, you're more defining how much you're putting in. And we found we can wipe out, people could come in with tax burdens of $300,000, $400,000, $500,000, and we can almost completely wipe those out using these types of plans. They're very powerful.
Yeah, tell me real quick that story that you told me before the show started. You had someone come in that was, going to have a hefty tax liability, and you were able to lower it for them.
Sure, yeah, I can sum it up by telling our audience this. If you've been frustrated with how much you're paying in taxes, when I ask people, are taxes high or low right now? What do you think they say?
They think they're high,
They're
right?
high, yeah. But guess what? They're not.
No, it's
historically, taxes are on sale.
Third lowest tax brackets that we've had.
And probably the lowest we'll see in our lifetime. As Larry Kaltikoff has said, economist and Boston University professor, the government would have to have over $239 trillion in a bank account today, earning Treasury rates just to be able to keep all the promises they've made over the next 70 years for Medicare, Medicaid, Social Security, and the interest on the debt. So if you're out there listening and watching the show today and you think, hey, you know what, that's alarming and tax rates are probably going to have to go up, that would be a reason you'd want to give us a call. Take advantage of this window of opportunity so we can start implementing some of the strategies we've been talking on the show today, and we can implement that specifically for you. You can call, get a retirement readiness review, a written financial plan. We'll do that complimentary, no cost, no obligation, and we'll put the tax map together along with that.
Wonderful. Tim, Jeremy, thank you so much. To our viewers at home, that number to call to take advantage of this very special offer is there on the bottom of your screen. Simply dial 866-256-7778. Or again, you're also welcome to take out your smartphone and you can scan that QR code down in the bottom right-hand corner, and that will get you connected as well. More on this week's edition of the Retirement Compass right after this.
My story started when I was in college. I was trying to figure out what I wanted to do. I knew it was going to be in the financial industry. I took a lot of accounting and finance classes. I thought I'd probably work in like a bigger company and work my way through maybe the accounting department. But then when I was doing a internship the summer before my senior year, I walked into a business. I was trying to sell magazine ads. I don't know if I call it magazine ads, but basically ad space in the back of the UNK student handbook and planner, which was a difficult sell because, nobody uses pen and paper planners anymore, at least not college students. But I made my best pitch to some financial advisors. I happened to be Scott Noctegal that I met with that day. When I went for the close and tried to see if he was ready to sign up for some ad space, he said, yeah, no, I'm not interested in that, but it takes a lot of courage to have somebody to be willing to walk into a business, especially a business that really doesn't cater to your target audience, to put yourself out there in a way that the odds of you being successful are probably pretty low. That's the type of person we'd be looking for at our firm. Have you decided what you want to do? And I said, no, I really haven't, but I only want to work with finance because I like numbers, and math's always been my favorite subject, and working with kind of complex equations, almost like a puzzle. And so that's really where it all began.
Welcome back to the Retirement Compass. I'm your host, Kristen Oakley, here with Tim Kulhanek and Jeremy Gove with Stonebridge Wealth Systems, and a very important conversation that we are having today all about taxes. We've spent a lot of time on the show already talking about tax liability reductions for individuals, but something that you mentioned before, and I want to get more into this, is this cash balance plan. And you work with a lot of small business owners, and this is a strategy you're often able to employ for folks, right?
Yeah, absolutely. So when you think about small businesses, there's 26 million small business owners in the United States today.
Wow.
And when you think about our market, the world we live in, Nebraska, Kansas, Iowa, South Dakota, a lot of those small businesses are farmers. Mm-hmm. And typically they're family-owned businesses. So they might be like a sole proprietor, an LLC, mm-hmm. an S Corp. Some of them are set up as C Corps if they're older families that have been. That's just the way that they set those up. Mm-hmm. And so in many of those families that are in a C Corp, they're trying to figure out ways to get to an S Corp. And it's really challenging because you have retained earnings potentially of millions of dollars that they would have to realize to get to an S Corp. Mm-hmm. And so that's where this cash balance plan can really be helpful. When you think of a farmer, what do they have? What's their assets? Well, they have land, mm-hmm. they have a lot of equipment, right. And a tractor today is $400,000 to $500,000. So just one tractor. And what do they typically do? They depreciate them very aggressively. So if I'm a farmer and I'm going to retire, I won't need my equipment anymore, so I'm going to sell it. Mm-hmm. Well, if I sell that, I'm going to have to realize a lot of gains, which actually is, not A long-term capital gain, it's ordinary income because I've depreciated the asset out. And so one of the benefits of the cash balance plan is we can set this up prior to their retirement. There's some rules around it that we would want to make sure that we follow. So just at a 30,000 foot view, we can set up the cash balance plan for you. And then when you do retire, we can absorb a lot of those gains or a lot of that income and offset it. And Tim has a great story that he worked, one of the farmers in our local area that he worked with.
I'm excited to hear this. We love stories on this show, so
I'm a
take it away.
storyteller, yeah.
Yes.
Yeah. So, you know who a great storyteller was, by the way? Paul Harvey. Was he not the best? Do you guys remember Paul Harvey?
Yeah, I love
Paul Harvey, Good Day. Oh, man.
Yeah.
I have memories of that, eating triangle sandwiches at lunchtime my mom made for me.
Let's hear your impression of Paul Harvey.
I can't do it, no. So you didn't know when the story ended and the ad began because he was so good. Anyways, the story is this. I had a couple call me last year in December, like the last week of December. And they said, we got a bit of a tax problem here. Like, not a little bit, a big tax problem. We had a great year, and this is a farm family. Grain prices were much higher, over $6. They had prepaid a lot of expenses the previous year, and so they didn't have a lot of write-offs. And they're getting close to retirement, so they're not really that interested in buying a new tractor or putting new grain bins up.
Doing a lot of things that people do to try to lower that tax liability, right?
And when I say a big problem, I mean like a $545,000 problem. That was going to be their tax liability if they did nothing. And so they visited with their CPA, and their CPA said, well, we could, you can do nothing and just write the check. And there's $545,000 your hard-earned dollars that goes to the IRS. You could prepay $500,000 worth of expenses, and that'll knock the tax bill down. I think it was to $316,000. Or you could, as he put it, pay the boys uptown $1 million, prepaying pretty much everything, and that would knock it down to about $150,000 you'd still owe. So there'd be $1.15 million of your dollars that would be gone. Fugazi, it's fairy dust. It's the IRS's now.
Right.
What we did is this. They prepaid the $500,000. We then took $650,000 roughly, and we opened up one of these cash balance plans, fully deductible. Of that, about $100,000 went into a medical reimbursement account, which will grow tax deferred, but then they'll be able to use those dollars completely tax-free in retirement to pay for anything they want to medical related. Eyeglasses, a knee replacement, long-term care expenses. If you don't have long-term care insurance and you think, oh, I'll just self-insure, well, here's a way to do it tax-free, okay? So it was very, very powerful. We actually wiped out their tax liability 100%. They paid hardly anything. And again, this is money that they can use here in a few years when they retire. It was a phenomenal thing. It was really great.
Well, I'm excited for more folks to get to connect with you and take advantage of these awesome strategies. So again, call that number on the bottom of your screen. Stonebridge Wealth Systems is here to help and serve you. We appreciate you watching. We'll see you next time.